The market gave us a real stress test overnight, and the timeline matters.
Exactly. This wasn't random noise. The sequence started with U.S. jobs data at 8:30 a.m. Eastern Time on Wednesday, then rolled into crypto pricing through today's morning session.
Payrolls came in stronger than expected, and that pushed rate cut expectations lower for the next Fed meeting.
By this morning, prediction market pricing for a near-term cut had fallen to around single digits, which is a big shift in just one day.
Why does that matter for crypto? Because when cuts look farther away, the discount rate pressure on risk assets usually goes up.
And yet we still saw resilience attempts in Bitcoin after last week's sharp liquidation. That's where the narrative gets interesting.
The second concrete signal was fund flow. Morning data showed heavy net outflows from spot crypto ETFs on the previous session.
Right, and that creates a very useful read. If price stabilizes while ETF flow is negative, it suggests some sellers may already be exhausted.
If price can't stabilize, then the outflow story is still dominating and institutions are probably not done de-risking.
So this is less about guessing a bottom and more about reading whether capital is transitioning from forced selling to patient accumulation.
Now to influential voices. At Consensus Hong Kong, Tom Lee said investors should look for opportunities instead of trying to perfectly time the bottom.
That sparked debate because it sounds bullish, but the framework is really about time horizon. He is not saying volatility disappears.
On CNBC, Michael Saylor reiterated his long-term view that Bitcoin can outperform traditional equities over time.
And that triggered a second debate. Does long-term structural adoption matter more right now, or does macro still dominate in the short run?
Educational takeaway here is simple. Strong opinions from major voices are most useful when you map them to time frame and assumptions.
If the assumption is long-duration adoption, short-term drawdowns do not invalidate the thesis. If the assumption is easing liquidity soon, macro misses hurt quickly.
That distinction is what separates narrative chasing from real investment thinking.
Our lens today is event-driven. Macro repricing, ETF flow pressure, and high-profile conviction all hit the tape together.
When those three line up, the market usually reveals whether this is a temporary capitulation phase or a deeper repricing cycle.
We'll keep tracking what actually happens next on flows, policy expectations, and participation quality.